Welcome to the IREL podcast. Are you sick and tired of real estate gurus pitching their next pre-construction deal only to find out years later they were completely wrong? Worried the next overseas conference you spend thousands to attend will only be used to sell overpriced lots and deserted developments? Join thousands of other international real estate seekers who are looking for their place in paradise without the sales pitch. Straight from your host, Taylor White.
Hey, podcast listener. Welcome to the Overseas Property Insider Podcast. I'm your host, Taylor White. I am proud to say this episode is brought to your earbuds courtesy of my friends at VRBO. If you're a homeowner or property manager and want to reach up to 18 million targeted travelers each month and earn incredible returns of up to $63,000 per year, then you must check out VRBO. With solutions starting at zero upfront or traveler fees or small flat ongoing fees, they have developed solutions for everyone. Head on over to irelpodcast.com/VRBO for more details. We hear from a 1031 tax-deferred exchange insider today when I sit down and speak with Ricard, who is a vice president and account executive for the Northern California division of the Investment Property Exchange Services and coming to your earbuds from San Francisco. Ron and I go knee-deep into specific strategies and tactics real estate investors should consider, including better explaining the overall concept of a 1031 tax-deferred exchange, the exact kinds of properties that are allowed, the specific timeframes involved that we need to be aware of, and much more. Instead of telling you more, let's join Ron from the IPX 1031 headquarters. Ron, what's going on? It's Taylor White. I'm excited to have you on the podcast straight from the Investment Property Exchange Services headquarters so we can get to know you personally. Tell us a little bit more about yourself.
Well, Taylor, it's great to be on. I really appreciate the opportunity. I've been involved with 1031 exchanges for the last 12 years. Our company is what is referred to as a qualified intermediary that helps people through the 1031 process. And it's a lot of fun. Love helping clients out.
So, Ron, I know that you're vice president and the account manager in Northern California. Can you talk a little bit more about what you do professionally at the company?
Well, the main thing that I do is that I help educate clients about exchanges. I'm not the one who actually does the paperwork, who actually prepares the agreements or sends out the money and that kind of stuff. My job is to give classes, meet clients, and go over the process and just get everything started to make sure the clients are comfortable with what the 1031 is, what the rules are, how it affects them, and sometimes, to tell them they don't need to do an exchange or don't want to do an exchange, but whatever is needed in the best for the client. And then once they are ready to get going, then I pass it on to a group of great people who actually do the paperwork.
So, Ron, why don't we just jump right into it? And what are 1031 tax exchanges and why do people use them?
1031 refers to a section of the tax code that allows people to sell real or personal property that they use for business or investment and reinvest that money into other like-kind business or investment real estate. And by following the process of 1031, they get to defer paying taxes. So the easiest thing we can think about is when it comes to real estate. You have a client or you own real estate like a rental house, a fourplex, an apartment building, a shopping center, whatever. You sell that at the end of the 1030, at the end of escrow, the money comes to the intermediary. That's what we do. You then go find that fourplex or whatever you want to buy as a replacement property. We send the money to the title company on the replacement side, and that effectively is the exchange. They sold investment real estate, they bought investment real estate, and because they never touched the money, because that was our job, they get to defer paying taxes on the profit that they made.
So, Ron, we have an Overseas Property Insider podcast with listeners in about 68 countries. So before we go further, we're specifically talking about domestic real estate inside the U.S. for another property inside the U.S. Is that correct?
That's correct. And what happened was up until the 1980s, actually, you could do exchanges all over the world. So sell in California, buy in Japan, sell in New York, buy in Canada. But unfortunately, the 1980s, Congress changed the law. And now 1031 exchanges have to be domestic real estate say, for domestic real estate. Now, you can go to the U.S. Virgin Islands or Guam, cannot go to Puerto Rico, but anywhere else in the United States, you can sell. You have to buy within the United States also.
So then, Ron, what kind of properties can be exchanged for?
The main thing is what you sell and what you buy both have to be investment real estate. So this is not for your primary residence. This is not for your second home. This is not for people who are flipping property. This is for people who are have a piece of real estate that they are either renting out, a piece of real estate that they are using to run their business from. If it's bare land, it's considered to be investment real estate because it's held for appreciation. So what you sell and what you buy both have to be investment real estate, but it can be any kind of investment real estate.
And then I've done, I believe, about 5 exchanges myself personally, but it's been a few years, and I know that there's some time frames that are involved. Can you speak more about the timelines?
Well, the most important thing to remember is when you're doing an exchange really is the timelines, because I mean, obviously you're going to sell something, you're going to buy something, you know what the process is. The timelines though are the most restrictive. You only have 45 days from the close of escrow to identify what you are going to buy in replacement, and 180 days to close escrow. So 45 days to tell us what you're going to buy and 180 days to actually buy it. Those are calendar days. If the deadline falls on the weekend, that becomes your deadline. You don't get the next business day.
So then, Ron, let's take a step back and kind of give us a little picture. I know that we're talking about 1031 exchanges. I know to you this is secondhand nature. For listeners, though, they might not even know kind of what we're talking about yet. So we have an investment property. We're looking to sell it. There's going to be some profits there. Kind of walk us through the basic outline.
Well, first, let me step back one thing. You asked something earlier that I didn't quite get a chance to, I didn't actually answer it, having to do with why people do exchanges.
Right.
Essentially, you don't do a 1031 exchange to defer taxes. You do a 1031 exchange because you own a piece of real estate today and you want to own a different piece of real estate tomorrow. You want to buy something better, whether better means bigger real estate, a different location, multiple properties, whether it's something that is just a better cash flow, better appreciation, whatever you want. The reason people do an exchange is because they own a piece of real estate today and they want to own something different tomorrow. And 1031 is the tool that you use to get from here to there without having to pay taxes every single time you sell a property. Because like when you sell your stocks in your stock portfolio, whenever you sell the stock, if you want to reinvest that money into other stocks, you got to pay taxes. Because of 1031, you don't have to when it comes to the real estate.
And then, Ron, I don't want to get too much lost in the legalese of this because I know people's eyes might gloss over a little bit. But simplified, this is an investment property. So it's not one that you're living in. It's not a primary residence. It's not a vacation rental that you're going to use. It's something that you're not using. Is that correct?
Well, if it's a vacation rental, you actually can. But you're right; it's not a primary residence. It's not a second home. If it's a vacation rental, it may qualify depending on how much you use it. But it is strictly for property used for business or investment.
So then, Ron, how much money do I need to reinvest?
The answer is all of it. So if you sell the property for, let's say, $500,000, then you need to buy something for $500,000 or greater, equal or greater is the key here. If you buy something less, then you pay tax on the difference. A lot of people think you just need to reinvest the profit or just reinvest the equity, and the answer is no. Whatever you sell your property for, that's how much you need to buy, equal or greater, in replacement if you want to defer all your taxes.
And then, Ron, I know. Well, I hope this is legal because I did this a few years ago. If you're selling one property, let's say it's at $500,000, and you need to reinvest the money from that property, you can do that in 2 properties if you want, or 3 properties. The idea is that all the money is reinvested and it's going to be something greater. Is that right?
Yes, you can sell one property by 2, 3. I did an exchange last year for a woman who sold one and bought 18 properties.
Oh, wow.
Yeah, and you can go the other way also. You can sell 2 or 3 properties or 18 properties to buy one replacement, though the key there is if you are going to sell multiple properties to buy one, obviously much larger replacement, the 45 and 180-day clocks start when the first one closes escrow. So that becomes a little more constrictive depending on what kind of properties you're selling. But the idea of selling one and buying multiple, I see that for a lot of clients. And as long as everything you buy is identified during the 45 days and everything is purchased during the 180, then you're in great shape.
So, Ron, I'm curious, what are some of the steps that most people get tripped up on when they're doing this? Is it they don't do the timelines correctly? Is it that they can't find property or properties that they want to reinvest their money in? What are the things that most people get wrong?
Well, the first thing people frequently get wrong is the fact that they forget to enlist the intermediary. We'll talk about that in a few minutes, but
Yeah.
it's very important that they enlist the intermediary before the close of escrow, because that without us, you can't do the exchange. But secondly to that, in today's marketplace, finding a replacement property in the 45 days can be problematic, because there are a lot of markets in the United States right now that are very short of inventory. So
Right.
that becomes an area that does trip up a lot of people as well.
So then I have a property. I'm looking at selling that property. I'm going to reinvest into one or more properties. Which comes first?
You want to sell first. You always want to close escrow on what you're selling before you close escrow on what you are purchasing, because you do need the money from the sale needs to go into what you want to purchase. If you need to buy first, there is something called a reverse exchange, but that's a much, much more complicated and expensive transaction, because you have to get an intermediary involved to actually purchase the property using your money. So it's a completely different kind of exchange. So if we want to keep it simple, if you want to, keep this to under $1,000 in terms of overall cost to you to do the exchange, you want to sell first, then buy. You can be in contract simultaneously for the two properties, but what's important is when you close escrow. And again, you want to close escrow on what you're selling before you close escrow on what you're buying.
So, Ron, I'm curious, where are places that I can buy property, number one, and then number two, as a follow-up, since you deal with this every single day, where are some of the spots that people are looking at right now?
It's funny. As the market changes, what people buy and where they buy really has evolved.
Right.
Back when the market had crashed, a lot of people were selling high-end areas and buying lots of smaller properties in lower markets that would improve that was very cheap and improve their cash flow. Right now, what we're seeing is it's kind of depending on what they want to accomplish. I mean, if your goal is to build and you want to buy more real estate, we're seeing a lot of people sell their single families and their duplexes to buy fourplexes, apartment buildings, something that's going to improve their cash flow, because on a per door basis, it reduces their expenditure. So we're seeing a lot of people do that. I'm also seeing a lot of people starting their retirement planning. So the idea of using the 1031 exchange to go buy a house in Hawaii or Florida or Arizona, or in a place that they might eventually want to retire to. I'm seeing a lot of people do that as well.
So, Ron, I know that we're talking about states inside the U.S. Are there any states in which you can't do this?
No, fortunately, a 1031 is a federal law, and all states pretty much follow 1031 lockstep. So you can sell in any state, buy in any other state. There's no limitation.
And then I know that there's some territories. Can you better explain what territories these can be done in, and then some that can't?
I just did an exchange to the U.S. Virgin Islands. I know that we've done Guam before. I believe you can do the Marianas. I know you cannot do Puerto Rico. I'm not sure what other territories we have.
Me neither, Ron. I just wanted to throw it out there to you, buddy. So then, Ron, you talked about it a little bit. Most of your clients or your company's clients, do most people do this for a long-term strategy? So it's on investment properties. Do they do it buy to flip? Do they do it on rentals? What do most people use this for?
Well, first off, let's start with the flip. Flipping does not qualify as investment real estate. When you're buying something for the purpose of reselling it, like buying it, fixing it up, and selling it,
right.
That's like a store, buying a piece of beef, cutting it into pieces, wrapping it individually, and selling it off. The IRS calls that a job, so it's not even taxed as capital gain; it's taxed as ordinary income. So flipping doesn't qualify. The vast majority of the people who are doing this are people who buy real estate and hold it, whether it's a year or two or a little bit longer. But it's not uncommon for us to do an exchange, and 3 or 4 years later to have them call us up and say, "Hey, I'm exchanging that property and buying another one." I've done sometimes 3-4 exchanges for people in a row, because there's no limitation. You can exchange your entire life. I've done some clients, I've exchanged 10-12 pieces of real estate for them. There's no limitation as to how much you can do this.
And then, Ron, is there a certain period of time that you have to hold a property for?
The IRS, if they ever look at your exchange, if they ever audit you, the question they're going to ask is, did you buy the property with the intention of it being an investment? And usually most accountants say 1 or 2 years. If you've been renting it for 2 years, usually there's no problem. Most accountants like to see at least a year. In terms of how aggressive you want to be, really depends on your history in real estate. I mean, if you're a massive flipper, if you flip property all the time and you do an exchange after holding a property for a year, you're probably going to be looked upon, did you really own it as an investment? For most of us, though, who don't have that kind of history, most accountants recommend it being rented for 1 to 2 years.
And then, Ron, we can do this on properties where we have mortgage loans, right?
Oh, absolutely. So let's say you have a property that you have a $500,000 sales price, and let's say you have a $200,000 loan, so you have $300,000 of equity. Again, if you want to do an exchange, you need to buy at least $500,000 worth on the replacement. The $300,000 of equity that you have needs to be used as a down payment. And now the key is you can get the remaining amount however you want. You do need to replace the loan, though you can replace the loan with your own cash. So most people just replace the loan with another loan. However, if you have the cash in your pocket, you want to buy something that way, that's perfectly okay also.
So, Ron, I know one thing that's common is people will buy a house as their primary residence. Years go by, 5 years, 10 years, their kids grow up. They want to turn that property into a vacation rental or some kind of rental longer term. Can this kind of thing be worked out?
Absolutely. As a matter of fact, there are a lot of advantages for doing this. For example, let's say you have a client who's in that situation. I mean, the market we just came out of, the downturn where a lot of people bought new houses, and the market was so low they didn't want to sell there, so they turned their house into a rental. The nice thing about doing that is if they sell the property within 3 years of moving out, they can actually still call the property their primary residence and get their $250,000 or $500,000 exclusion, right? Because the law there says that the property needs to have been your primary residence for 2 years during the 5 years preceding the sale. So in that case, they may still be able to call it a primary residence. Now, the good news is, if your gain is way above that $250,000, $500,000, this is actually a fantastic tool to use to get the advantage of both tax rules at the same time. So you turn your property into a rental for a couple of years. Now, when you sell it, you still get the $500,000 if you're married or $250,000 if you're single. And the key there is now, because the property's been rented out for a couple of years, you can still do a 1031 exchange on the rest of the money.
So, Ron, I don't want to get too confusing, but I'm going to ask you a question that's very confusing. I know that we're talking about 1031 tax exchanges. Do people ever use this in conjunction with a self-directed IRA?
No, because a self-directed IRA is already in a tax-deferred vehicle, and therefore you do not need to do an exchange if you own real estate in your self-directed IRA.
Perfect. Okay, then, Ron, what are some of the problems that can arise doing 1031 tax exchanges?
Well, we've already talked about some of them, primarily in not finding a replacement property or not finding one that's large enough in dollar value. The real areas that people can have issue with, the IRS does have a few things to be very careful about. I call them my red flag areas, right? That people have to be knowledgeable about. 99%, or I should say 95% of exchanges never run into these, but let me give you a couple of examples. The IRS does not like transactions being done with what are referred to as related parties, primarily family members. So you need to be very careful when you're doing a transaction if you're either buying from or selling to family members. The second red flag is seller financing. If you're going to sell the property and the buyer says, I need you to carry back a note, you don't want to do that if you're doing an exchange. There are ways around it, but as a rule, a seller financing really does complicate the exchange. The third thing, which is probably the most common red flag, is vesting. What's important is if you sell, you have to buy. So if Taylor sells, Taylor has to buy the replacement property. You can't give the money to your son to buy the replacement property. And where that becomes an issue is on title to the property. If you own the property yourself, great. If you own the property with partners, well, now we might have a partnership issue. You may have a corporation. Again, if the corporation sells, the corporation has to buy.
Okay, Ron, that was an awesome job talking about some of the problems. Now, why don't we backtrack again a little bit and better explain what a qualified intermediary is and why someone might need one?
Not might need one, must need one.
Okay, sorry, must need one.
Now, the IRS requires that when you do an exchange, then that the person doing the exchange cannot have what's called constructive receipt or control over their money. And so our entire job is twofold. One is we create the paperwork that shows the client or that tells the IRS that the client followed the rules of the 1031 exchange. But the more obvious thing that we do is we hold the money between the time the client sells and the time the client purchases the replacement. Because if the money ever goes to the client or the client has control over the money, then the money becomes taxable. So the IRS requires the use of what's called an accommodator or a facilitator, intermediary. That's the role that we provide, essentially creating that paper trail to tell the IRS you did it properly.
And then, Ron, if I have an investment property and I want to do a 1031 tax exchange and I have tenants in there, does this affect whatsoever with rents that I get from tenants?
Not really. The only thing that you have to be very careful about, and there are ways around this, is when you are selling the property to somebody else who's also going to be using the property as an investment, you may have a proration of rents or security deposits. And when those are being transferred, it's very easy to make it look like somebody's receiving cash that may become taxable to the recipient. So you just need to be careful when it comes to the prorations on the closing statement. But for the most part, it really has no impact. Now, by the way, this also means that if you're buying the property from somebody who's doing an exchange, it has no impact on that buyer. Even though there is something referred to as a disclosure for the buyer that tells them the seller is doing an exchange, it actually has absolutely no impact on the other party.
So, Ron, I know that we've touched on this just a little bit, but in real estate, we're kind of always looking for the next deal. So we might already own something, find another great deal. Can we buy the replacement property first?
You can go into contract, no problem. So if you find a property and the timing works out that you can still close yours before you buy the replacement, then perfectly fine. If you get into the situation where you have to buy first, that's the reverse exchange. That's where essentially you have to come up with the money to go buy that other property. We as the intermediary would take title for you, and then you have 6 months or 180 days to sell your property. Again, much more complicated, requires much more money out of your pocket. Plus the fees to do that kind of exchange are probably going to be somewhere $5,000 to $10,000, which is, far more than, under $1,000 for a regular exchange.
So then, Ron, who do I need on my team to do this? I'm thinking I'm the buyer. I have some agents involved. I have a qualified intermediary involved. Who are the people that are a part of this puzzle?
Well, the nice thing is there's no difference. If you're doing an exchange, there's no difference in selling the property and buying the property from a normal transaction. You're still using your realtor. You're still using the title company. You're still using the lender. You're still using all the same components when you're selling a piece of real estate and buying a piece of real estate. The only thing you need to do is to get the intermediary involved once the property you're selling is in contract, to create that paper trail with the title company. So other than that, let me step back one thing. I also always recommend that if the client isn't sure about what their actual tax liability is, or if they even need to do an exchange, I always recommend that it's a good step for them to talk to their CPA, to their tax advisor early on, if not even before they even list the property, just to see whether or not they even need to do an exchange. Because I've had plenty of situations where clients thought they needed to, and because of some carry forward losses or other issues, they may not need to do an exchange. Similarly, I've talked to a lot of clients who never thought they had to do an exchange, but because of depreciation write-offs or other issues, they have a much larger tax liability than they expect to. So getting your CPA involved is probably not a bad idea either.
So then, Ron, I'd love to ask you one more question, but how can I wrap up property improvements when I buy the replacement property? And then also I'm thinking of in my mind, there's going to be sales costs. I pay agents commissions. There's sales fees involved. So how can I wrap all of this together so I have nothing coming out of my pocket if possible?
Actually paying real estate commissions, escrow, title, transfer taxes, anything associated with the actual cost of sale of the property can be wrapped into the exchange. So so you can subtract those on the selling side. You can wrap those in on the buying side. The only major one you cannot wrap in is the lending fees. So lending fees, points, appraisals, anything associated with the loan itself is not considered to be part of the closing costs. So that cannot be, that if you pay for that with exchange funds, that could be viewed as taxable. So that's the one area you do want to be careful about. But other than that, all other expenses you can factor in. Now, a question you asked, and I get asked this a lot, is, well, I want to go buy a new piece of property, but it needs a lot of work.
Right.
And so can I keep $30,000 in escrow and just, pay the contractor or, do the work as I'm left, you pay tax on. So to the degree that you can get the seller to do some of those expenses and reflect the expenses in the purchase price, that could work. Another thing that you can do, if you have a lot of work to do, like over $100,000 worth of work on the property to do, there is something called a build-to-suit or improvement exchange, where as the intermediary, we take title to the property for you, do those improvements, and then, quote unquote, sell you the property back once that work is done. Again, a much more complicated transaction, and it's really only economical if you're doing, close to $100,000 or more or more worth of improvements on the property.
So then, Ron, I would love to wrap up our call with a bow tie or action steps if we can. What are some final tips or strategies you might want to recommend for listeners?
The first thing I would say is if you're thinking about selling the property, you want to find out whether or not you want to do an exchange, or you need to do an exchange, and what the steps of the exchange are before you even list the property. If only because sometimes there's something that comes up while, after you've already found a buyer for the property that may make it too late to change something that could really mess it up, like a vesting issue or something like that. So the first thing I always recommend is, if you're thinking about doing it, get informed first. Hopefully this podcast is going to help some people, but obviously anybody who listens to this, if they were thinking about doing an exchange, is going to have more questions. Get information early, ideally before you even list the property. So if there are things to be addressed, we can do it first. Once you want to do an exchange, I strongly recommend finding a real estate agent who's knowledgeable both when you're selling the property and when you're buying the property, because finding someone who's been through this before, they're comfortable with those timelines, which are very important to the process. Just surround yourself with good people. I mean, whenever you own real estate, it's nice to be surrounded by good people in the first place, but this is another one where especially you want to make sure you have good people working with you.
And then, Ron, what are some of the best ways to follow or else connect with yourself or else your company?
Well, our website is IPX1031.com. Our company is called Investment Property Exchange Services. IPX1031.com is our website. We have great information. We have people all over the country. My number, toll free, is 877-747-7875. Again, 877-747-7875. I can take phone calls pretty much anytime and love helping clients out.
Ron, fantastic call. Thanks again for coming on, and I hope we can do it again soon.
Anytime, Taylor. Whenever you want me, just bring me back on.
Wow. I want to thank Ron once again for coming on the show and breaking down the specific strategies and tactics involved with doing a 1031 tax-deferred exchange inside the U.S. You can head on over to our site for complete show notes, easy ways to connect with Ron, and more information about his fantastic company at the Investment Property Exchange Services. And don't forget, if you're a homeowner or property manager and want to maximize your rental returns while keeping your costs down, then you must check out one of the best vacation rental sites anywhere, and one that I have personally used several times on scouting trips throughout Latin America. The best part, you can get started completely free. Head on over to irelpodcast.com/VRBO for more details.
You have been listening to the IREL Podcast with Taylor White. Be sure to hit up irelpodcast.com for more. That's irelpodcast.com. Thanks for listening.